YouTube, this is GWS, and it's time for some more secular bullshit. Take two. Anyhow, we got Mr. Kyle Kalinske here. Just unbelievable ignorance. I was just gonna write this in a comment, but it's just better to put it in video format. I don't know, makes me feel better, I guess. All right, let's listen to the video, and we'll see where I got about 3 minutes of it down. It's a 13-minute video, so I'm guaranteed to have more than I bargained for. But let's listen to what the dumbass has to say. Oh boy, he insulted Obama. Oh, you don't insult Obama. A little bit salty there, Kyle. You see how the dumbass doesn't even get where he's like digging himself into. I wouldn't call it a contradiction, just like talk about somebody who doesn't know math. Okay, you said the stock market more than doubled, and then the market before Obama went in office went down 50%. That's like digging a ditch, filling up the ditch, and then thinking, and then bragging, look at this mound of dirt that I built up. Realize how asinine that argument is? And then you're gonna see his numbers don't even add up. So let's listen in more. Disappeared, poof. Okay, this once again, just a basic economics lesson for Kyle. When money gets divested from the stock market, it doesn't just vanish, go poof. That's not how it works. See, what happens during a crash is, and I can't even believe I'm having to explain this, is you get a bubble, right? Tech bubble, housing bubble, tulip bubble, whatever, just some kind of bubble. Um, and it's going to happen with cryptocurrency probably sooner than you think. You get this bubble that's building up, 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 because the value is created based on the speculation that the value of X commodity will go up. And this is what creates the boom bust cycle is you get something with speculation. People throw money at it, it tanks in value. But see, what happens is people who divest from it initially, who plummet the value, the money is temporarily taken out of the system. Because what an investor usually do, if they sense a bubble, they're going to wait for that bubble to top out, and then they're going to divest everything and plummet it, send it plummeting. And so you have the people who initially divest, who get all the profits, and then The people who wait and think, oh, this isn't like a permanent bubble. People who wait for everything to tank, they're the ones who lose out. But see, what happens is you get those initial investors, even, well, all the investors that pull out, the money doesn't go right back in the system. So, no, value does not just poof. It is money stored, and this is why you get, if you look at every crash in history, 1800s onward, as long as there's been economic data on this, you see, you get up, 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 and then crash, and then you get an immediate bounce back. It won't bounce all the way back to the top, but it'll bounce back to something that more represents its value. Because when you have the value of given commodity, when that bottoms out, people are going to start buying it because it's the opposite effect. Like, you get the bubble, then you get the crash, where people are undervaluing the asset, and then you get the smart investors who will say, this is bottomed out, I'm going to buy some of this back. And that's how you get the correction. That happens to the whole economy. It's a long-winded way of explaining a speculation bubble. But see, Kyle doesn't even understand that. He didn't know the value poof, gone. No. That's not how it works. like, look at the GDP numbers too. Look at real GDP, not the nominal GDP. But you look at GDP. We only had 1 year of loss, and it was about negative 0.1%. Why? Because the people who are mostly losing out, you had a lot of unemployment, you had a lot of layoffs, but most of the people who lost out were the rich. See, that's who the value tanks for, is the rich. It's like, that's why you want these speculation bubbles. They're not a bad thing to have. Because what I call it is a tool for separating stupid people from their money. Because you got a lot of stupid people with money in this country, right? Okay, so you're for meritocracy, right? If you're a liberal watching, if you're a liberal watching this video for whatever reason, you want that, right? You want the Paris Hiltons, you don't want them having money. And so, see, what you have is you have these traps that get built up in entities like the stock market, or like what's getting built up in cryptocurrencies. It's people building up the value as high as they can, trying to get stupid people to throw their money at it. And then what's going to happen is, once the stupid people run out of money, they're going to flip the switch all at once, and you'll see it. You will instantly see it. Because that value's going down. Like, you talk about Bitcoin, all that, it'll probably get back up to, well, it got up to 20K. You had a mini crash. It lost about half its value. But I think the bigger crash is going to be kind of down the line. Especially if it's looking like banks are going to regulate it, because it doesn't have a future. But anyhow, that's cryptocurrencies. That's another debate entirely. But the point is you need a mechanism in a capitalist society to separate stupid people from their money. Stupid people who don't know a thing about investing, who don't know the signs of genuine value increase versus a fanatical speculation bubble. They don't know the difference, and they throw their money at this, and then they get caught in the trap. It's basically just like that. It's a mousetrap. But anyhow, let's move on. I spent way too much time. I shouldn't have to explain this, but there's a certain segment of YouTube, even those who listen to my channel, who just don't get it. And yeah, you don't like it, but I don't care. Anyhow, let's move on. That's a little more than double, wouldn't you say? Well, you said more than doubled, but that's closer to three times than really two times. Um, like you want to round that up a little bit, maybe say almost three times. But anyhow, we'll hear what else he has to say. No, after a crash. Uh huh. Yeah, yeah, not possible. Why doesn't dumb white boy there look at the how what the Dow was in 2000 and 2004? It's had a doubling rate pretty damn fast. I'll just say that. Like, I remember, when I was in school, the thing was like, you know, under 10,000. But anyhow, let's move on. Ignorant statement alert. Yeah, see, this is the point where I had to stop it and make the video because this is where it gets into just being unbelievably stupid. It's nobody is talking about when you're talking about the total health of the U.S. economy. It's not about how much average people own in terms of stocks, in terms of companies. This isn't a socialist country. There's a lot of people who want to make it one, but this is not a socialist nation. We're not Germany, okay? We're not we're not a social market economy. The stock market, I agree, it's not the best measure. You have GDP now, which is that's not even a particularly great measure, but that is a far better measure of the health of the U.S. economy in general, especially because that specifically measures production in the United States, whereas the health of companies that are in the United States can be reflected in their international affairs. Like if they're making stuff in China or something that could increase their assets in this nation. So, you have outside influences on the market like that. But, to say that it's just a reflection on the elites, no, you can get some things from the stock market, like the health of a company, the financial strength and stability of a company gives it the ability, not necessarily that it will, but the ability to create more jobs, better jobs, more high paying jobs. Um, it reflects their ability to expand, both expand their premises and expand their workforce, provide better products and services for the consumer base. There's a lot of things that you can, with reasonable accuracy, infer from the stock market. You know, especially the direction that companies and industries going to go. Like, investors are like, they talk with their wallets. Like, where do they want the country to go, and what do they want to see from the companies that they're invested in? And the more you see those investors flock to certain companies, the more you can kind of guess the direction that our advancement is going to go. So there's stuff beyond how good the rich are doing that you get from the stock market. It's just, so let's listen in more.
Him. Remember when he was railing against the establishment as a candidate and he was pretending to be populist? This is fundamentally the opposite of a populist argument. This is, oh, you know the people who were already doing amazing? They're still doing amazing. Unbelievable. That's what he's doing. That's what Trump's doing here. And listen, you can go back and check. This isn't a partisan rant I'm doing here because I said it repeatedly. I always had a qualifier when I spoke about the market under Obama. I said, okay, yes, the market has more than doubled under Obama and a giant rebound, but that's not something where you go, what a wonderful success. What an amazing thing he's doing. Because really, that's a reflection of how the rich are doing. And the fact that a Democrat or Republican is serving the rich is really the problem with our system. That's the problem with our system, is that they're representing the rich and corporations. They're not representing regular people. So, another angle to this is the stock market is a reflection on how the rich are doing, but also it's a reflection on what? Corporations. And we have record corporate profits right now. We also have a record income inequality. So the better corporations are doing, the worse regular people are doing. Now,
Oh my god. Oh my god. Income inequality does not mean that one is taking away from the other. So, okay, so let's just say this scenario. I'm not saying this is how things are going, but this is just to prove that argument nonsense. And it's always been proven nonsense because liberals keep going back to it. And I agree that there's something to be said about inequality. It's not a meaningless stat. You want to have a low Gini coefficient, Gini, Guinea, whatever, however you pronounce that. You want to have a low coefficient, um, because you don't want that unequal of an economy. But to me, it's a symptom of a problem rather than the problem itself. But let me just explain this scenario. You know, if you have, say, the bottom 80%, their standard of living, their income only increases 2%, and the income of the rich increases 50%. That increases inequality, but is anybody worse off? No. It just means the gains have disproportionately gone to the rich. Again, not the most desirable situation, but having more of one does not take from the other, unless you're Obama, when it did. Because under Obama, you did have lost wages, and those wages never recovered for a variety of reasons. And Obamacare is chief among those reasons. So let's listen to more because I don't want to be here all night with this dumbass.
here's the part that, in the mainstream media, they'll roll their eyes at this and they'll scoff at this and they'll say, oh, he's so rich, he doesn't know what he's talking about. He's, armchair pontificating. What does he know? A crash is coming. A crash is coming. And again, people start
Evidence?
bragging about the insane explosion of the marketplace under Obama also, but under him, he's bragging about the explosion of the market under him. That is going to come back to bite him in the ass in
Still waiting for evidence.
fucking Obama, Democrats in Congress, other Republicans. I mean, everybody but him is going to be responsible for it. He's going to have no clue how to handle it, of course, in terms of what to actually do to fix the situation. But when the crash comes, listen, there's a million and one things that could be the catalyst that lead to the market totally collapsing, going into free fall and crashing. I don't know exactly what that thing is going to be, but I have a few ideas of what can spark it. So first of all, we have the
Like,
derivatives market, which is a multi-trillion-dollar market, and it is totally unregulated. So this is the casino capitalism that all reasonable people have been warning you about. That, oh my God, this is bets on top of side bets, and it's puts and it's calls, and it's basically the people on Wall Street who, through propaganda, have convinced us that they're the smartest people in the room. It's those people taking your money and doing the most insane.
let's see. We're kind of gonna test that claim because I'm interested. Let's look at. Let's see if we can find this information. Okay, here's Realty Check. Okay, this is let's see if we can see a bubble kind of forming. This is so this is just three cities. In the U.S. as a whole, you had this. You had from '05 to '09. Um, here's um, quarter one 2007 when homes were at their peak. You had 373,000. I'm assuming that's dollars. That was the average value of a home. Now I'm not sure if this is nominal or if this is inflation adjusted. I'd like to see, but this doesn't really. Let's see if we can find it. Okay, but when adjusted for the inflation, it's still 20% below. Have recovered nearly all their losses from the 2000. Okay, well, I guess that gives us a little bit of information. So I guess this is not adjusted for inflation because they're trying to. But anyhow, you had homes. On average, they lost about $100,000 in the U.S. as a whole, and now they slowly climbed up again. In fact, let's see if we could get more detailed stuff. It doesn't look like we're going to. Let's see. Here's 20. Okay, so this is the green line is the U.S. as a whole again. This must be. The only thing I can think is this must be anomaly. In 5 interactive charts. House price index. I'm not sure what index is. How about real terms? Okay. Duh, I should have looked at that. Alright, so real terms you had this is weird. Okay, this is hundreds of thousands of inflation adjusted. So you get 216 to 116. Let's see if we can kind of get where the crash is. The crash happened. Well, this wasn't the actual crash. But the point is, you don't really see much of a bubble forming around the housing market. So here's percentage change. Okay, that's Realty Check. Here's Zillow. Zillow might. Well, this is giving us recent. I'd like to see something more in depth. Here we go. Now, if we can get before 2008, then I'd be happy. Here's 5-year running mean, um, but see, this isn't giving me what I want. Not in the least. But see, this looks like it could be a bubble. But anyhow, let me just explain why Kyle's wrong here in general, without spending too long trying to look for specifically what I want to look for. Is the difference between now and then. You've always had a huge securities market. Securities have been around since forever. Like, it's just essentially high dollar insurance. It's insurance for people who are underwriting mortgages. It's like, and then these get traded around, like based on their value, based on the likelihood that someone's gonna not foreclose, not default in any way. And what you had in 2008 is you had desperation in the market, because what you had record home construction across the country, because home prices were climbing, climbing, climbing in value, and because of that, you had this real estate market that was growing. More and more neighborhoods were being built, and people had to fill those houses, and they had to keep finding buyers. And they started running out of buyers in like the mid 2000s or so. And so they had to do the absolute last straw, which was loan money to people who had no business having money, and trying to take any shortcut necessary to get people with low credit scores home loans that they often could not pay off. And then when you finally even ran out of those, and when a lot of those started foreclosing, more of them were actually buying homes, or to the point where the value of the homes was not going up, the appraisals weren't, then that's when people were forced to ditch, get out, drop on their golden parachutes, take their huge bonuses, and get out. You know, it was a desperation market. It wasn't the derivatives themselves, the existence. It was, you had a desperate situation formed by a multitude of factors, including some government factors, because you had the Federal Reserve, who didn't change their rates until 2006, where they were forced to raise the rates, because it's like you're looking at home prices, you know, looking at some homes like being over $400,000 or whatever, and it's like the Federal Reserve looked at that and like, oh, we gotta react, but it's, you can't do that. Like, if you're the Federal Reserve, um, your job, if this should be your job at all, but your job is to regulate the flow of currency. What does that mean? That means to be ahead of the game. When you see the flow start to increase, you raise the funds rate so that you raise the Fed funds rate so that the flow does not get out of control. And you got to watch these different sectors. You got to watch real estate. You got to watch where all the money's flowing. And if you see something starting to look like it's forming, you can't just passively watch. And this is what we've had the Fed do. We had it under Bush, and we had it under Obama. Except for Obama's even worse, because you have what's called quantitative easing, where the Federal Reserve actually lowers their interest rate to negatives just to keep the money flowing, just to keep inflation above 1%. Because what they don't want is deflation. Because deflation, um, they say, is just going to lead to um, a discouraging of investing money. But that's just it's a little bit too complicated for this small mind right here. But you know, the fact is this: like the mere existence of derivatives is not any sign of the stock market going to crash. So let's listen, and maybe you have some logic to kind of back this up. I don't know. Let's listen.
Making bets like they're in a casino, and as any gambler knows, eventually that bubble.
And I do agree with that. By the way, it's not necessarily like there's not a bubble. Like it doesn't appear that there's a bubble bursting. Like you have to have a bubble bursting for. And so it's like we'll listen in more to see if he has evidence of this bubble forming. Like if the real estate market right now is a bubble, because there's just no way that it can be a bubble. There's just not enough money um, flowing into real estate for it to be a bubble at the moment. There's not enough um, growth. There's not much growth, period, for there to even be false growth. But let's move on before I get into another 20-minute rant.
Bubble bursts, and then you're in deep trouble. And what's amazing is that under this administration, it's like they act like we never had the 2008 subprime mortgage crisis and Great Recession. They act like we don't have the lessons of history from what just fucking happened. It just happened 20 years ago.
Are they loaning money to subprimes?
It was deregulation and tax cuts for the rich under Republican and Democratic administrations, the repeal of Glass-Steagall, that led to a boom-bust cycle. And what does Trump do? He comes in there.
Oh my god. Oh my god. Oh, really? Oh, this is just getting too much. Oh my, just so much crap. Okay, first of all, Glass-Steagall did not regulate securities. Glass-Steagall did not tell banks they could not loan to people with bad credit scores. There's nothing about Glass-Steagall. I don't even think Dodd-Frank says that. It might. I don't know. But um, no. All Glass-Steagall was it separated the commercial banking from investment banking. So in other words, you had investment bankers who were governed by the SEC, who traded in securities and investments, and they had all these different packages and all that. Um, and then you had the commercial banks, your Bank of Americas, your Wells Fargo's, all that. Like that just did commercial banking. That means you have checking accounts, you have savings accounts, and not much else other than that. You can't have investment accounts. You can't have um, any of that. It's just commercial banking and like direct loans, things like that. Like they're not investment banks, and they're governed. I think it's by the Federal Reserve itself, if I'm not mistaken. Um, or like by the FDA. It's I'm not sure exactly. Like I think it's the Federal Reserve, but my point is um, that you had commercial banks who were punishingly regulated. But um, aside, whether you believe in Glass-Steagall or not, I mean, there's an argument for it. It's not a very good one, but even if you believe in it, it's like there's nothing about Glass-Steagall that would have stopped the crash, because the crash happened in the securities market first, because you had people foreclosing. The value of the securities is what tanked. The value of the securities tanked, which meant people divested, which meant the value of housing tanked. The foreclosures caused the value of homes to tank, which caused more foreclosures because people were all of a sudden paying $2,000 for a house that was worth 100,000, and through a 30-year mortgage they're going to pay like 500,000 plus on a home that's worth 20% of that, and nobody's going to deal with that, right? So you have people who foreclose because they're not staying in that deal over a tanked house because they can't get any kind of equity on it. So it's that's what happened. It had nothing to do with Glass-Steagall. And let's see, what was the second thing he said?
that under Republican and Democratic administrations, the repeal of Glass-Steagall, that years ago. So it was deregulation and tax cuts for the rich under Republican and Democratic administrations. The repeal of Glass-Steagall comes with stress tests for the big banks.
Oh, I remember the thing that he was saying. He was talking about the boom bust cycle. Like, I don't know if Kyle's aware of this or not, but after FDR, you've had, what was it, like 11 recessions before the quote Great Recession? 11 different recessions. You had the post-war recession, which was crippling. It was only a couple years, but it was a crippling recession. Um, you had recession at the end of the 1950s. You had recession, and you had a few recessions in the 70s. You had some in the early 70s. You had like two in the late 70s. You had two in the early 80s. You had the late 80s stock market crash, 89 Black Monday. You had, or was it 80? It was 87 or 89 Black Monday, and then you had the 93 crash, and so you've had plenty of crashes before the Great Recession. you know, it didn't create a boom bust cycle. That's a feature of any economy because all economies you have periods of boom and you have periods of decline. That's just how economics works. Like, you're not going to keep growing forever and ever and ever. You're going to have periods where you may be stagnant or you may be declining. That's just how it works. But he says it created the boom bust. Like he doesn't even understand the basic feature of economics. Like, put this guy in an economics class, he's not gonna do too well. So let's listen in more.
Well, you want to talk about Dodd-Frank. Even though Dodd-Frank was weak Wall Street regulation that was passed under Obama, that was one of the good parts of it. They were stress test the banks and make sure that they're not over leveraged. Well, Trump and some corporate Democrats, including Joe Manchin, and virtually the entire Republican Party, were like, we don't need that anymore. Things are going great now, so let's get rid of that group. Are you fucking kidding me? So we're seeing the same thing that we saw then. We have the derivatives market, which can be the catalyst for the crash. We have credit card debt, over $1 trillion worth of credit card debt in the United States of America. We have student loan debt, over a trillion.
Okay, how is credit card debt going to create a crash? Like, I honestly don't even under like how how can you relate that? Okay, so let's just go through the basic fundamentals again. A crash happens because of what? Because some segment of the economy loses a large amount of value, right? And so, credit card debt, like, what segment of that is going to cause value of something? Like, are credit cards going to start losing value? Like, you have, okay, so some credit card companies, fail. Guess what? That money goes back to the banks. you know, like, they're not the ultimate creditors. And student loan debt, like, that's money going to the bank. So it's like if they default on their loans, then what happens? Like, where's the trigger? How's this going to trigger a crash? Let's see if he expands. But I'm just curious.
$1 trillion. Guys, student loan debt is not a thing that exists in many other modern nations. Scandinavia managed to get free college.
Oh
Not
God,
only do we not have free college, we have over $1 trillion in student loan debt that
that's
eventually
why.
have to file bankruptcy on. So it's this permanent debt that they're saddled with that's just hanging over their heads for their entire life. You have some people who are senior citizens still paying off their student loan debt. You have some sitting Congress people still paying off student loan debt. You don't think this is a giant systemic problem? Okay, we have
What does this have to do with
a
crashing?
housing market that's right back in a bubble. So not only can we have, or not only will we have another crash, we will have another giant crash that might have the same roots. So what happened is the subprime mortgage, you have the subprime mortgage crisis and the economic collapse in 2008. But after that, everybody acts like, oh, the housing market has it's rebounding. No, what happened is Wall Street decided we're going to go buy up all the houses of that where everybody got their houses foreclosed on. They were kicked out of their homes because they couldn't afford it because they were, bullshit predatory loans that they were giving that had a ballooning interest rate as time went by and they couldn't pay it. So Wall Street went back, bought up all those foreclosed homes, and now they're renting them back out cheap. So when everybody goes, oh, see that everything rebounded, it's fake. It's fake growth. I'm telling you, man, it's a matter of time.
Okay, how is that fake growth? Now, first of all, okay, what was the trigger for everything in 2008? We've went through this multiple times. Even you just went through it, Kyle. 2008 subprime mortgage crisis. What does that mean? Loaning money to people who could not possibly pay back the loan because they had low credit scores. Many of them based on just the fact that they don't have the money to pay their mortgage. So you have Wall Street, you have a housing market. Okay, maybe, I saw some rise in the Zillow stuff. So, okay, I don't know. Maybe you could define that as a bubble. That's for people who are smarter than me. But okay, say it is starting to increase in value. Then, like, you have people in Wall Street buying up the homes, buying, not mortgaging, but buying. They own the property. And they're renting out homes. Like, is there a danger that is there some kind of security for them where they can't pay their mortgage? This isn't a thing where you are betting on a poor person's ability to pay a mortgage. These are rich people buying homes and renting them out, which is probably part of the reason why rent's gone through the roof. Because renting is all that's going on anymore. They're just buying homes and renting them out. Assuming Kyle's right about that. He's just, I don't know. I think I give Kyle the benefit of the doubt a little bit too much, to be honest. Way more than I should, because I've called this guy wrong on so many things once I've looked it up. But, like, assuming he's correct, like, okay, they're renting out homes. There's no, you know, if they don't, if they're unable to rent out the home, you know, what's the worst that could happen? Because it's not like a stock market where there's a market and they sell the home and they instantly get their money. No, it's like, okay, someone from Wall Street isn't renting out the property because rent's too high and nobody's renting homes, right? And they want to sell their home. Guess what? It doesn't mean someone's going to buy it. you know, and yeah, you can have home prices decline overall, like if you get people trying to undercut and buy low and all that, and Wall Street starts accepting it, but it's not going to be a crash situation where you have a huge percent of neighborhoods being foreclosed on. That's not going to happen. You know, that situation really couldn't happen unless you're dealing with the falling of securities. But let's listen in some more.
Time. It's just a matter of time. And then probably the two most important facts is wages have been stagnant since the 1980s. And when wages are stagnant, what happens? Your average Joe can't afford to go buy the goods that the so-called captains of industry are producing. So you have, you know, the the capitalist system rolls on. They keep producing surplus goods, but now regular people don't have the money to buy those surplus goods, and then that train is going to grind to a halt now, isn't it? That's when we're all in real trouble.
Um, I don't think Kyle understands this thing called inflation, but yeah, he's right. Wages have been flat since about the 1980s. Actually, a little bit before that, but the 1980s nonetheless. But that is accounting for inflation too. So they're not losing their ability to buy from the quote captains of industry. Their buying power, at least compared with the strength of the dollar, has not increased. Um, and there's a million things you can say about that, but in terms of like causing a crash, in terms of it grinding to a halt, like what does that mean? Like people are just gonna stop consuming? I don't know. It just makes no sense. Like, see, here's the thing. It's like when you're talking about crash, you're looking for where's the bubble? Where's the big bubble? Where is everybody throwing their money? Where's all the irrational money? And that's the key, the irrational money. Like I said, I think it's in cryptocurrencies right now. I think they're massively overvalued. You look at what some of them are going for. You could tell it's just because you know these cryptos they're going into markets, um, and these markets are not regulated by governments, which has a positive impact, true, but it also has some instability. And some of that instability is, you get into an uncontrolled market where you don't have a Federal Reserve, even though you have the cryptos, which are, the supply is set um, based on the blockchain algorithm. You have the supply set, the demand is not set. The demand can increase for bitcoins and it can decrease, and this is how you can have, when you're talking about comparing it to the dollar, and the same thing even happens to precious metals, gold, silver, platinum, all that. You get this with precious metals too, is you get wide variations of the value, and I think crypto is going to collapse. But it's like I said, it could be anything. Like look around the market. Where's the bubble? Where's all the money going? And the sad thing too is I can name another realistic thing too. Um, that where the next crash is likely gonna come from, but it's going to be based on whichever government has the balls to do it first, and that is, um, I believe it's going to come from the financial sector. Not real estate, not wages, not your student loans or credit cards. No. If you look at where the money's going, like I said, crypto, but you also have the banking industry, which has become top heavy because of Fed funds rate policy under Obama. And I haven't looked at it under Trump, but I suspect that the Reserve, I think they raise interest rates a little bit, but they're scared to raise them much because they know what's coming. And yeah, you're going to get a crash, but it's going to all be in the financial sector because of all the money that's accumulated based on the Fed funds rate policy. And see, this is why you're not seeing a lot of progress in other sectors because everything's going to the finance industry. Everything's going to the banks. And the minute you get somebody who goes in there and decides, we're going to shut this down, we're going to raise your Fed funds rate to back to 4%, what it was under Clinton, that's when you're going to get your crash. But no, Kyle doesn't see that logic. Like, where's the bubble? No, he sees, well, look at the things I'm concerned about, like, student loan debt, credit card debt. You know, it's all about, you know, what his Marxist concerns are. He wants free this, free that. So let me just throw this out there, hope it sticks. Even though I don't have an argument for it. His student loan debt, everybody be modern nation, blah blah blah. It's just retarded. But let's try to get through this video.
Because what the rich don't understand is that in the long run, it's actually in their benefit to allow the middle class to have a decent share of the wealth. Because when the middle class gets too poor,
What do you mean allow?
and nobody can afford to buy their goods, everybody's fucked. So historically, during the Great Depression.
So okay. Jeez, I gotta stop this right here again. What does this mean? Allow? Like allow? Like companies are supposed to be benevolent and say, I'm going to give this to you because I like you a lot. You're a good person and you're important to me. That's not how the economy works, Kyle. Sorry to say, that is not how the economy works. You have a capitalist economy that is based on competition. Who can get ahead, how fast, expand, be the first to go into a market or to be at least competitive, with where you're allocating your funds and your resources. You know, that is like economics is science. It's not a feelings based thing. You can't just say, be benevolent, be nice to people, be nice to your workers. That's not how it works. It's never been how it works. It wasn't how it worked in Eisenhower. It wasn't how it worked under FDR. It's not how it works today. In India, in any industry, I don't care what you're talking about that's privately funded. And so when you say allow, like this godly industry, this benevolent industry, please, 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 let the middle class in. That's not how it works. You have to draft a policy that scientifically, and that's the key word, because what we're dealing with is a science, the science of economics, a policy that encourages the flow of wealth, the flow of least resistance, to go toward normal people. a policy. And even like if you believe in Keynesian economics, where the government investment drives demand, which drives industry. Um, that is that's the goal. Like you're trying to get money through policy into the hands of people. It's not benevolent industry. Please give more money. That's not how it works. It's not a thing where they say, you know, we're going to make everybody poor because we're greedy corporations. No. If you are valued as a worker, then you will get more money. If the value you provide and their need for you demand that you receive more money, you're going to get more money. That's just how it is. And that's where um, that's where you want basically this is how you want it. I think it's best put like this: rather than you demanding a job, you want the company to demand the worker. And there's a big difference between those two things. Because it's like, let's use a hypothetical. If you have 1,000 jobs who need one worker, um, and you are available, you know, imagine what those jobs will do to get you to work for them. Because like they need that worker. That without you, they're going to suffer. They're going to go out of business. They're going to suffer financial loss. You know, you have 1,000 companies who are bidding for your work. So what's going to happen? It's like you're going to shop around each of those 1,000, like who offers the best rate, what's the best place to work, who treats their workers the best, what's the best amenities around where I'm working, and that's how things used to be, right? But see, now you have an environment where you have 1,000 people applying for one job, not 1,000 jobs looking for one person. You have, as a hypothetical, I'm not saying this is real, I'm just using the extreme, 1,000 people looking for one job. What do you think's going to happen? Now, all of a sudden, the job has the negotiating power because that job go through each worker. You know, what are his qualifications? What's he demanding? What does he look like? Is he part of, you know, is he a family friend? Is he a relative of a family friend? Or, is he a friend of a worker? You get into stuff like that. And it's like, once you start having lots of people trying to apply for one job, then you lose your negotiating power as a worker. So your wages get pounded into the dirt. And that's sadly what's happened in this country is you went from, like if you wanted a job, like, you can find a job instantly and you can shop around for jobs and, you get the job that's going to pay you the most. Now it's like, if you're an unskilled worker, you're extremely lucky to find somebody who will take you. And if they take you, you know, you'll be lucky to make anything above minimum wage. It's that bad. It is that awful. So it's like you want to have the job that wants you rather than you wanting the job. Like you want them to need you more than you need them, basically. So let's move on from this.
The top 1% were making about 24% of the nation's income.
Not biting on this one.
The top 1%
point.
stable.
Your point.
And then you have a crash, and you have a correction of the market.
Well, then you have a crash. Okay, what about that causes a crash? What about, oh, they're making 24% of the income, like, you know, what about that causes a crash? I can see it's not a desirable situation, but we're talking about crashes. What causes the crash? Again, theme, lack of evidence. Let's move on before I get into another rant.
Yes, and of course with the New Deal, that helped massively. Um, but then during what's called the golden age of economic expansion in the United States, we were the main economic superpower, and when we had uh, intelligent regulation of the marketplace, and you had a social democrat making the decisions, FDR with the New Deal, the top 1% started making about 12% of the nation's income. So, in other words, a great reduction in income inequality, a booming middle class, you had strong unions at the time, and so people had a slice of the pie. This is what we call the American dream.
Okay, now this is massively misleading. First of all, he's right. Income inequality was down back then, but here's the thing he forgets to mention. We had a tiny fraction of the economy that we had today. And actually, um, I was going to look at the stat, but it doesn't really go back far enough. It's U.S. Census poverty rate. Um, like, when they started the poverty rate, poverty was about at 22%. Um, and that was at the height of, that was like 1960, I believe. That was Eisenhower's last year. That was the height of the golden age of economic expansion, right? Because you had all the 1950s where everything expanded. Yet you still had huge poverty. Why? Because the economy was still small back then. It was very small. So, yeah, you didn't have a lot of rich people. That's true, but you had lots and lots and lots and lots and lots of poor people. So this is incredibly, incredibly misleading. You had a lot of growth, but you had a lot of poverty. And what's interesting too is like ever since the war on poverty, you haven't had poverty go down at all. It's bounced between 12% and 15%, and you haven't had much wiggle room between those points. So, anyhow, let's listen to more.
So, the top 1% were making like half of the income that they were making before. They're making about 12% when times are good. And then the system is well oiled and it can keep chugging along. And we didn't have a crash, a market crash, for decades after that because we had strong regulation and we had less income inequality.
See, okay. Now see, this is I actually have viewed this a few times, but let's see all the recessions since FDR. Let's put Kyle's little claim to the test. As you can see, okay, here's Great Depression onward. You had the Great Depression, um, which they say ended in 33. I actually, you had recessions throughout the 1930s, and it never really recovered. But anyhow, see, this is an interesting thing too because it has GDP decline. So we'll kind of go through that. Let's see. Recession of 1945, 8 months, minus 12% GDP. 49, minus 1.7%. Um, then you had 53, then 58, and then you had 60 to 61. See, these are 1.6, so you may say they're meaningless, but it's like if you look at what the 2008 recession had, that was just like less than 1% loss. So in terms of total GDP, it wasn't a big loss, but we've already went through that. So 69, 70, 73, 75, 1980, 81, 82. And I think this is just the early 80s. This is just a separate article. All early 1990s. You also had I know you had Black Monday in the late 1980s, but I guess they don't count that. Oh yeah, you had the dot-com bust. Then you had the early 90s. So you had tons and tons of recessions since then. Even with the post-war economic boom, you had 58, 66, and it's just ridiculous, his claims.
But then inflation, and we had less income inequality. Decades after that came along, and we didn't have a crash, a market crash for decades after that. Extreme.
Idiot.
Then what? Then top 1%, we're making 24% of the wealth again. 24% of the income. Wealth is different. We're making 24% of the nation's income again. Well, guess what? We're hovering around 24% right now. The top 1% is making about 24% of the nation's income. Totally and completely unsustainable. And this house of cards is going to come down, and it's going to come down soon. And President Fuckface bragging about the market exploding when the market isn't a reflection of how regular people are doing in the first place is embarrassing, it's pathetic, it's sad, and, start that clock because that crash might be coming sooner than we all think.
It's almost like you're hoping for it, but yeah, you are. That's the comment I was about to leave. But let me turn this thing off so we don't have problems with that. But anyhow, that's the video. That's Kyle's economic ignorance, and this has gone on for way too long. So thanks for listening, guys. God bless, and have yourselves a good night.